Today we're going to talk about Panera Bread Company. Panera Bread is one of the leading companies in the fast food and casual dining industry. They are currently located in 45 states, Washington, D.C., and Ontario, Canada. Panera Bread went public in 1991 and has continuously been able to successfully grow due to its focus on the service it provides and its high-quality products. Panera Bread was founded in 1981 by Louis Kane and Ron Shake. It began as Aubin Pan and St. Louis Bread Company. In 1999, Panera became the official name. Panera Bread currently owns, operates, and franchises 1,880 locations. The bakery cafe operations offer fresh baked goods, sandwiches, soups, salads, and other complimentary products, as well as provide catering services. The franchise operations segment licenses Panera Bread or Paradise Bakery and Cafe names and monitors the operations of these bakery cafes. Currently, Panera has 955 franchise-operated bakery cafes that are run by 35 different groups. Finally, the fresh dough and other products operation supplies fresh dough and products to all of their bakery cafes. There's a total of 24 fresh dough facilities in the United States and Canada.
Panera competes in the fast food and quick service industry, specifically the quick casual dining segment. Panera is a leader in this segment, offering fast food service with higher quality products. Panera's top competitors in this industry are Starbucks, Chipotle, and McDonald's. Its diverse target market includes consumers seeking a more upscale fast food dining experience and those willing to pay a higher price for fresher ingredients and healthy alternatives. Panera's strengths include its distinctive restaurant ambiance and experience, an innovative menu with fresh ingredients, and high-quality customer service. In terms of weaknesses, Panera relies on a limited number of suppliers, so any supply chain disruption would have an adverse effect on its operating performance. In addition, Panera is much smaller than its top competitors, such as Starbucks, so it lacks the resources to effectively respond to changes in industry conditions. Panera's opportunities include taking advantage of the forecasted growth of the fast casual dining segment in 2015, using technology to enhance customer experience, as well as offering more organic, low-fat, and sustainable food products. Panera faces the threat of high competition in the industry. The company is also threatened by any reports of food contamination and subsequent illnesses, and is currently facing a class action lawsuit which could negatively affect both its financial position and brand image.
The restaurant industry made a steady recovery in 2014 with similar growth projections for the coming quarters. Within the fast food and quick service sub-industry, Panera's lower price competitors are expected to be at an advantage due to the cautious, price-conscious attitude of consumers. However, higher priced food companies are still expected to experience growth.
To forecast Panera's future financial performance, we created a pro forma income statement. You can see our pro forma model, and the highlighted 8.12% is the revenue growth projection from 2014 to 2015, and the highlighted 17% is a gross margin we determined for 2015. We focus specifically on projecting revenue growth and gross margins. For revenue growth, we analyze the overall downward trend in their year-to-year revenue growth from years 2010 to 2014. The revenue growth has decreased from 18% from 2010 to 2011 to only 6% from 2013 to 2014. We also considered trends in revenue growth for each of Panera's three business segments, as well as overall industry growth projections and analyst estimates for Panera's future revenue growth. Panera's gross margin has been decreasing year to year, which may be due to intensified competition from low-price, high-value competitors like McDonald's. Average gross margin in the years 2010 to 2013 was 18.4%. But in 2014, Panera's gross margin was 16.7%. For our pro forma income statement, we used a gross margin of 17%. We believe Panera is undervalued because it has a lower price-to-earnings ratio and enterprise value to EBITDA multiple compared to its competitors.
Although return on assets has decreased between 2013 and 2014 relative to the industry median, it is still significantly high. This means that the company is efficiently utilizing its assets to generate earnings. The same holds true for return on equity. A more detailed DuPont analysis will be presented on our next slide. Looking at the liquidity ratios, the current ratio and quick ratio has been increasing between 2013 and 2014. Also, both of these ratios are higher than the industry median. This means the company has leeway to cover its short-term debts. Looking at the activity ratios, we can see that there's an improvement between 2013 and 2014.
The inventory turnover of 98.8 is very high compared to the industry median of 1.43, but we have to take into consideration that the companies selling perishable items have very high inventory turnover. For solvency ratios, we have taken a look at long-term debt to equity and interest coverage. The company had no long-term debt in 2013, but has taken $100 million worth long-term debt in 2014. This is the reason that the long-term debt to equity has risen to 0.14 and the interest coverage has gone down to 151.
Panera Bread appears to be one of the weaker companies within its closest competitor group. With the lowest profit margin of the group, Panera has the poorest operating efficiency. Panera leads the group in terms of efficiently generating sales with its assets, indicated by its asset turnover. Looking only at return on equity, Panera seems to be equivalent to Chipotle. However, through DuPont analysis, we find that Panera is more highly leveraged, inflating the company's return on equity. McDonald's and Starbucks are also highly leveraged and have poorer asset turnover compared to Panera, but both have significantly higher profit margins.